Hi everyone, welcome back to the channel if you're someone who's watched before, and if you're new then welcome. It's been a long time, I think about 2 years or so, since I last posted any public video, so it's certainly about time to do that again. And what I'm going to do today is go through a concept that I use a lot in my trading, a concept that I also teach to students, and show you it. I'm not going to show you the strategy I use to trade it, but I will take you through the concept itself, and you can decide on how you want to use that in your trading and your analysis, but I'm sure it's going to help out. So what I'm going to do is go through something called the swing failure pattern, or the SFP. So I use this, like I said, quite a lot in my trading. It happens fairly often on all time frames. So it's something you can use on whatever time frame you trade, basically. If you're doing your top-down analysis, you can incorporate this into that also, and also actually into possible trading ideas themselves. So I'm going to go through first off something called ABC, because that's how I view the market. And that's going to take us into then the swing failure pattern. So first off, if you go to any market, doesn't matter what it is, you're going to have swings. So there's multiple ways you can represent this. So I'm going to do something called ABC, which is very, very simple. Of course, the market has to move in, well, it can go sideways, but when it's moving in a direction. If it's going upwards, it moves like A, B, and C. If it's moving downwards, like A, B, and C. So effectively what you have is the A legs here are the kind of momentum, the impulse legs. The B is the retracement or the correction, multiple ways to say it. And then the C is the next impulse leg up. And of course in the downtrend, your A is going to be the impulse down, your B is going to be the retracement or correction back up, and then C is coming back down. So all this is going to kind of make sense when we incorporate that with the swing failure pattern. So effectively what's going on here, a lot of people know this as kind of higher highs, higher lows, higher highs, or in this case the starting point, the lower low, lower high, and lower low. So there's many different ways to represent it. I just use simply ABC because it's the simplest way. Now what actually is important here is the swing part of this. So when you have the market going in this direction or this direction, you're making swing points. So you're swinging from one way to another. So a swing point is simply a high or a low. So when you're thinking of the higher highs and higher lows in the uptrend, this is simply going to be a swing point, and again, and again. And in this downtrend here, you've got 1, 2, 3 swing points. Once this starts to move away, that becomes another swing point, because the market is simply swinging up, back down, back up again. The natural sort of motion the market goes in as it moves. What we're really focusing on this video is when the swing failure happens. So in this case here, if you can imagine these are candles, so big, nice momentum candles, smaller retracement candles, and again, nice big momentum candles. If the candles, let's say this is a daily chart, it doesn't really matter for now, but let's say a daily chart. If these candles are nice and strong, they're closing nice and big, and they finish and close up here. Clearly that swing, that ABC swing, is completed. You've had a completed pattern of the impulse, retracement, and impulse, and the same thing here. What we're really focusing on in this video is what happens when the C leg in either the uptrend or the C leg in the downtrend fails. So therefore you have a swing failure pattern, because that can give us then a possible reversal bias. So what I'm going to do is quickly go onto a chart and show you what I mean first off by this ABC quickly, and then in terms of when the swing is completed and when the swing has failed, and that'll take us on to the next part. So what we're going to want to look at then is a sort of completed swing, or a couple of ABCs. So Euro USD, pull up any sort of random chart you want. If we look at this wave here, if I bring out one of these tools on the side, so we have somewhere here an ABC, this one here. So we can call this wave, one wave up as an A, one wave down as a B, and another wave up as a C. So there you simply have, if we mark out those swing points we were looking at earlier, you've got a swing point here, a swing point there, another one here, and as you come up and start to turn around, that's simply another swing point. So the market's moved up, it's retraced, it's corrected, however you want to say it, and then you've got another momentum leg up, which is the C. So that's a completed sort of swing. You swung up, swung down, swung back up. You want to focus on, in terms of the uptrend, on this leg here, on that C leg, because this is the leg that could possibly fail. And if this leg fails, then that's when you may have a reversal in the market, and that's where the swing failure sort of part comes in. So I'm going to get rid of these parts now and then show you where you may have a swing failure. So if we go back to the drawn example and take away one of these sides. So here's a completed swing. So when we're talking about the candles, let's say the candles are coming up like so, they're nice and big and they're closing strongly above. When we're looking at the swing failure pattern, you want to concentrate on two things. This C leg here and where the previous swing high was. So like the previous resistance area. So clearly when the market breaks above that previous high and closes above, that's created a C leg. Because as long as you close above that previous high, that's a C. You've had an A, B, C. It doesn't really matter how far that C goes. As long as you close above that previous high, if you did something like this, even though you haven't closed very far above, that's still a completed ABC. It's a completed sort of swing pattern. What we're focused on now is, here you have your resistance area at that previous high. What happens if you come to that previous high point and then you fail on the swing? So not necessarily closing above and coming back down, because as long as you close above, it's completed. But what we're looking at is when the market comes up to a previous high, forms a wick above, and then closes back down below the previous high. So that's a swing failure because you failed to make a C leg. So you no longer, you could of course, immediately after it could continue upwards, in which case you've completed a C leg. But this is a very important pattern because this can indicate a reversal and can sometimes be very, very reliable. So if we take this example and look at this on the chart and see if we can find this sort of thing. It's probably a little bit confusing at the moment because you haven't seen an actual chart example, but I'll show you a few and hopefully in no time you'll be identifying them quickly. So if we just go back and look for a couple of swing failures, there's actually one in terms of an uptrend here. So we're thinking of the downtrend, sorry. So in terms of the downtrend, here you've got an ABC. So you simply got ABCs coming down, another one here, an A, a B, and this could have been a C. You're in a downtrend, the market's making lower lows, lower highs. You're expecting a lower high, you made a lower low, you've made a lower high, therefore you're expecting another lower low. So an A, B, C. What actually happens is when you come to that previous support zone where you had the previous swing low, so take the wick, it's always the wick low or the wick high because that's the extreme. So there's the low of that swing, there's your sort of swing point that can be represented like that here. So swing point, swing point, swing. Now what happens here is you actually fail at that previous swing low. So you see how you've made like a very bullish sort of hammer candle. You've got a wick just below. It doesn't go very far, but you have failed that previous low. If you can't see it properly, I'll zoom in a bit more. So there you can see the exact low of that candle, the exact low of that previous swing, has broken below, but then has closed very strongly above. So if this candle closed there, for example, that wouldn't be a swing failure because you've broken below the previous swing low and closed below it. However, because you've broken below, failed to close, that's pretty much where the fail comes from, is failed to close below or above, but then you've moved nice and strongly. That's a very strong swing failure. And you can see that that was the zone where the market turned around for a new ABC to the upside. So if we go back and look at some other major turning points, so if we go up to the very, very high where the entire market turned around. So here you had the market going upwards for a very long time. This is a daily chart, remember, so 2017, the end of that, beginning of 2018, all the way to the beginning of 2018 again. So that's actually a year. So beginning of 2017 all the way to the beginning of 2018. So a year of uptrend, and then everything since then is what we've currently been in to the present moment. So if we look at the high of the entire market here, how did that market end that entire year-long uptrend? With a swing failure. So if we take the high of the swing point there, you can see how we made, if I label the ABC again, we made an A, made a B, went to make a C, like so, but actually failed to make that C. Because we came to the previous swing point high, So if I mark out their swing points again, I'll mark out a few of them. So say we started down here, that's a swing point, made a swing, made another one, came down for another one, but this time we failed to make another one. So that's a higher low, higher high, higher low, higher high, another higher low, so you're expecting another higher high. I don't like using those terms. I usually just use ABC, but you fail on the C leg. So there's your A leg, B leg, C leg, fail at the high. So you see how that market actually ended itself in a daily swing failure. So if we go back, I'll just mark out a few other ones. So there's another swing failure here. You can see how the market came to swing back around but failed. That's another high point. Let's look at a few others. So if we go back and just mark out whichever ones I can see. There's a swing failure here. You've made an A, a B, failed on the C. You come up to the previous swing point, failed at the high, back down below. And you see how that's another reversal point. Let's keep going down a bit further. There may not be any more. That's technically a small swing failure here. You've moved away, you've come back again, you've swung, broken the high, closed nicely down below, have some bearish momentum from that. So hopefully you get the point there. There's quite a few swing failures within that, and a lot of those are areas where the market has made a high point and then come back down. And of course, like here for example, is a very small, it's not really a very good swing failure, but that is still some form of failure. At the low, you've come to a low point, you've swung away sort of. It's more of a consolidation. Ideally you'd want a move away and then back down again, but you have swing failed the bottom, and that's a reversal point on the downside. So you will find this pattern a lot where the market reverses. And of course, if you have a strategy on a lower time frame, you could use this either as a trade itself if you wanted to, or you could use this as simply just an analysis tool and say, okay, you've had a swing failure on the daily chart. If you traded a lower time frame, you can then find shorts based on the swing failure on the higher time frame, because that will give you a bearish bias. So we'll go through a lot more examples in other pairs too. That's just to kind of get the idea in the head as to what a swing failure is. So hopefully now you understand the concept of the ABC and the concept of the swing failure being a fail at the previous swing point on either an uptrend or a downtrend. So like I said, this can be on a variety of different time frames. We'll just go through a couple other ones that I've found earlier on. So Euro JPY, if we look at, there's probably quite a few on here. So what have I got then? So here's one just there. It's like a continuation swing failure more than anything. So the market is moving downwards. You've tried to, well here you formed a slightly higher low. So you could be thinking, well, this could potentially be a turnaround because you have ABCs coming down, then you get an ABC in the opposite direction possibly because you form that higher low. But when you come to the previous swing point, you swing fail, form a nice strong bearish candle and continue on with the trend. So sometimes you can use a swing failure for a complete reversal. So say it didn't happen, but let's say that down here the market continued to come down, came down to the previous low, made a swing failure. That's like a possible reversal swing failure, whereas this could be a potential continuation swing failure. So you can use them in both sort of scenarios. It just comes to identifying it and how to identify it properly. Let's go to Euro Pound. So on Euro Pound then, there was one, I'm just trying to find exactly where it was, one there. So that was a pretty big high point in Euro Pound, and you had a swing failure ending that zone. So here you've actually got a couple of different confluences because you've got a previous resistance level. So if I just draw across a box where you previously had some resistance back here, so if we draw that across, you've got coming into a previous resistance zone, and then from that resistance zone you have a swing failure here because you've got, I'll just delete that, remember that's the zone. So as you come up for a new A, B, sort of consolidation, but you're hoping to maybe create a new C if it's continuing the uptrend, but you do have a swing failure, nice and strong, and then the market finds a high point there. So you see what I mean, where the market will often finish this sort of way, because it can either form a sort of lower, if I draw it out, so it can either form something along the lines of enable this tool, either form this sort of thing like an A, B, C, and then of course form a lower high and then reverse, or it can come up and make that sort of swing failure. So it just breaks above. I mean, it can break really far above. It's just as long as on that time frame it closes back down below. We'll just do a small break above and then back down again. So there's a couple of different ways the market can end. A lot of times it will end like this sort of swing failure pattern. So like I said, either using that as a trade idea in itself or as a possible sort of analysis tool on a higher time frame to help you find a trade in that direction on a lower time frame. So let's go up another notch. Let's go to a weekly chart and have a look. So let's hop across to Euro Oz, go to the weekly. So currently we're actually in a scenario right now where I've recently used this idea to trade. The whole swing failure pattern thing. It's fairly common. I do use it quite often. So on the weekly chart of Euro Oz, you can see that, well, hopefully you can see now that we've recently had a swing failure. So we're at pretty major zone in Euro Oz. We're quite high up, we're into previous territory. So there's quite a strong resistance level here. This is a weekly chart again, so big levels, and we have made a swing failure from that. We've actually swing failed a couple of levels, so it's really quite important. So if we bring our little horizontal line tool again, horizontal ray tool, and you can see the swing failure from recently is here. So we came to that previous high point, went to make a new swing, a new C, but we failed that. We broke above, but then we closed back down below. Bit of messing around again, bit of consolidation, and then a nice big move away from that. But that was not just a swing failure from this high, but you also had a swing failure from this high. So it's like a double swing failure almost. Why this is important, and this is a good example to show you. A swing failure is simply when the market goes into an area of liquidity. So up here in this zone, anything sort of above a big high point, even a smaller time frame high point or low point, there's going to be a lot of liquidity, and liquidity simply means orders. So you're going to have stop loss orders from people that are short. You'll have pending long orders, pending shorts. Take profits from people who are long, and people shorting the market and longing the market at the actual levels at the time, the sort of market execution. So the fact you've got lots and lots of orders up here means this is a zone the market's going to be generally interested in, because the market sort of hunts zones of liquidity. So when the market goes up into that, during, obviously, like I said, the weekly chart, so during that week, the market broke above those levels, absorbed all that liquidity. So all those orders are absorbed, and obviously the sells came out on top. There was much more selling pressure, and back down below. So you failed to make the new swing. You've taken out liquidity from above this high and above this high, two big weekly levels, and you've closed back down below. So that's why it's so important, because of the whole idea of liquidity and the fact that's been taken out for a possible move to the downside. So if that candle closed even, like, let's say 1 or 2 pips above that previous high, or let's say this high, say it closed there, still had the wick but closed up here, there would no longer be a swing failure. So you do have to be very strict with it. It has to close below the high point of the wick that you're looking at. Now, swing failures can be good or bad, or sort of just like average. Obviously the swing failures that, if let's say the market came to just here and that wick was only there and then it closed 1 or 2 pips below, it really wouldn't be a very noticeable swing failure. I wouldn't be too worried about it, wouldn't really care. I'm not really going to use a swing failure like that in my analysis. I want it to be strong and show some sort of serious bias or momentum. So here, of course, you've got the swing failure there. You've got a big wick, still closed bullish. The hollow candles here are bullish, so that did close. It could be green you might have on your chart, or hollow like I do. But the fact is the market didn't close bearish on that week. But it's still significant because the wick is very long and it clearly closed quite far below that previous high. There's actually another one there. So that's another swing failure because you've come to make a new swing. That's a big swing failure. nice big break above and a huge close below, and you did get some bearish momentum from that. Didn't turn completely, but more often than not you'll at least get some momentum in the same direction. And of course you want to combine these swing failures with things like big levels, because that just increases the sort of effectiveness of it. So yeah, that's a nice big weekly swing failure. So let's say that you had a swing failure like this, and then on the daily chart you had another swing failure within this area here. You'd have like 2 swing failure confidences in one chart. You have the weekly swing failure and maybe a 4-hour or a daily swing failure within this. It could be a double sort of confluence. You can use it as you wish. So yeah, that's our sort of different time frames there. So we'll go down again to the 4-hour and we'll have a look at a couple of examples of swing failures that maybe weren't so good, if we can find them, and swing failures that wouldn't, well, swings that wouldn't be swing failures but might catch you out because they look quite similar. So Aussie dollar is another one I used fairly recently. We used this concept fairly recently. So on the weekly chart, if we actually go back to the daily, it's easier to see. So I got long on Aussie dollar. I got a very good entry, very, very low down here. If you follow, you would have seen it. So Aussie dollar, if we take the swing failure here, hopefully you've seen that one on the low. So the market was going down for a very long time. Big momentum. At some point this market's going to turn around. We formed a nice big swing failure. Not big as in the size of the wick, but especially when this candle came in, that was a nice momentum after a swing failure. So a big low, multiple lows. Actually you sort of got 3 swing failures in one, because you've come down, taken out the liquidity below all of these major low points, both weekly and sort of daily levels, and then you've closed nicely back above. So at this point here, if I just leave the bottom one on, the most extreme, on this candle, I wouldn't have been too worried about it at the time. So if I go back to, I think there. So if the market looked like this, I would note that that's a swing failure, but I wouldn't just sort of go long because there's a swing failure, because it's not really a very good one. The wicks are fairly equal both sides. It's quite a bearish candle. This could very easily continue going down. However, once you get the next candle, that went very quickly. Do that again. Once you get the next candle like this, that to me is a very bullish outlook, because there you have a swing failure. It's come down again like a, I don't really use candles like this, but the tweezer bottom formation that people talk about, like a double bottom on a lower time frame. So you've come, swing failed the low, come down again, second to a swing failure, and that's a nice bullish close. Big wick to the downside, not so big to the upside. That shows me that the market can definitely go up from here. And if we press play, that was quite a major low point. So we're now back up at this previous high. So let's say that now the next candle, if I grab, where is it? Trend line here. So let's say the candle, the next one goes up and does something like this and then closes. It's going to look a bit silly because I'm drawing it like this, but let's say the next candle closed something like that, right? You can sort of see what I mean. That would then be a swing failure to the upside. And if I saw a candle like that, looking nice and strong to the downside with a wick breaking above the high, that may signal, it would be quite a strong signal to me, that this could now start to have a bigger correction to the downside. Could be coming to make a new ABC. If I grab that, I always lose which one it is, the brush. So if I saw something like this, this could then be the beginning of a new swing point to come back down, I don't know, for another A, B, swing point C. But all you're really interested in is the fact that this has failed, and you may have some at least short-term bearish movement, if not longer-term bearish movement. And that's all on the daily chart there. So I hope that you understand what I just did there, and you understand the concept of swing failure a bit better. So of course I'm not telling you how I'm trading this, because I do have my own strategies, but that's not really for the public. That's my own strategy or for my students. But the concept itself, I would like to share that. So that's the swing failure pattern. I'm going to go through a couple of others. I think there's a triple I found earlier on. So if we go to the 4-hour chart, then we've been on the daily for quite a while. So if we bring up the 4-hour chart and we go to August. So let's have a look. So there's a big one here. Right. So this SFP, I think that actually came... Okay, so what I was talking about earlier when I mentioned the SFP within an SFP. So you can have like a weekly SFP, and then where you've had that, you may also have a 4-hour one. So you've got like two of them in one. So this is a 4-hour chart. If I mention the SFP just there, so there's the failure pattern. So again, this candle closes bullish, but it's still quite a bearish candle because you've got a nice big wick breaking above that high. If I then go back up to the daily, so that's where we had that 4-hour swing failure, that actually comes from a weekly swing failure. So there's a weekly swing failure here. Let me just move that back down to the 4-hour. Let's make it just visible on the 4. There's our weekly swing failure. So at this point here, let's say that the market was there. That's quite bearish to me because you've had the swing failure, then you've had some nice bearish momentum. So the market's quite likely to turn at this point. So you've got your weekly swing failure. So let's go back down to the 4-hour chart and see where we had that 4-hour swing failure. It's actually just in here. So back down to the 4-hour, and you can see that you've got within that bigger weekly swing failure, you had a move away. There's that swing failure was here. There's momentum to the downside. Came back up for a final push. Swing failed the high, which is just there. And then you had the beginning of the new downtrend. So that's like a swing failure within a swing failure. So what I want to go, one of the last things I want to go through quickly is what sort of differentiates a swing failure that's kind of sort of valid and invalid, because what you want to focus on also is the length of time since the swing, because sometimes you can have something that looks like a swing failure but it's way too closely compacted together, so it's not really a proper swing failure. So if we head on to Aussie dollar and look at yesterday, obviously yesterday means nothing if you're watching this in the future, but yesterday was 21st of October 2019. So if we go to the 4-hour chart, which we're on, let me just check something. So this here, right, this is a good example. So let's go to the 1-hour chart. On the 1-hour chart, you've got an hourly swing failure. Take that high point. The market has swung upwards. It's come for a new A, B, tried to make the C but failed. Nice big bearish rejection candle. Very high probability that that market's then going to turn, at least for a bit. Doesn't mean it has to reverse and fall thousands of pips, but it's going to have some sort of bearish momentum. So there we had a swing failure on the hourly chart. Now you see how the market, this is what I'm talking about when I say swing, you have to remember this. Market comes up, swings away, as in moves backwards, back down, then has like a period of time before it comes back up again. So that's like a big sort of swing area. What you have to be careful of is that you don't mix this up with something that's way, way too small like this. So bear in mind this pattern here on the 1-hour chart. If we take this back out to the 4-hour, and you'll see how it was a valid 1-hour swing failure, but when you take this out to the 4, that's not a valid swing failure, because that's not really a swing. So you can see how it still marks out. So if you saw that on the 4-hour chart and you class this as a 4-hour swing failure, I wouldn't say that's valid. If it was a 1-hour, then fair enough, that's correct. But on the 4-hour chart, you see how it sort of just consolidated a bit and then had a little push up. That's not really a swing. Ideally, if this was a swing failure, let's say we get one now, you'd have to swing away, move back up and then come back up and make a swing failure from the high. So you really want to focus on not these tiny little moves, but big, big swings. Like there's a big swing here, there's a big swing there. This is still a swing. That's a swing failure at the low here. I think I traded that. It was a while ago, like a month or two ago. So there's the previous low. You've moved away somewhat. That's probably the bare minimum. You do move away. You do have a swing and a swing back down. Comes to the previous low, take out liquidity, close nice and strong, market reverses. So that's sort of the last point to really say is be careful with how wide the swings are. You want to have a proper ABC swing, not just a tiny little move like so. So really that's the concepts in a nutshell. hopefully you can use that. I'm sure you can, if you didn't know already, or if you did know already, perhaps you've expanded the knowledge a bit. I do use this a lot. It happens very, very often. Once you've got some experience with it, you can notice them very quickly. It's probably going to take a little bit of time to identify it properly. Of course, you can come back to the video and maybe mark the examples out on the chart that I've done from previously, and you can go back and see those in the future. So yeah, I'm hoping that's going to help a few people out. If you do have any questions, you can drop me a message at rb.fx@outlook.com, rb.fx@outlook.com, or you can email me through the website, which I'll put a link in the description and also at the end of the video. Or of course, if you follow me on Instagram, RubenBlameyFX, just send me a DM and I'll be happy to help out. So hopefully I will see you guys soon on another video. Won't be 2 years again this time, and I'll speak to you all soon. If you're a new trader or you're experienced but you're struggling, I do run mentorship programs, so all the links are here on the screen now. If you go to the website, you can check through the details of the mentorship program. Send me an email, use the contact form, or send me a DM on Instagram and I'll be happy to chat with you. Hopefully speak to you soon.